Hi looters, welcome back to Tick to Loot market updates for August 4th, 2026. Today we'll dissect yesterday's data releases, walk through today's calendar, and tie in the latest headlines. Remember, this video is for educational purposes only and is not financial advice. Markets carry risk. Always do your own research and consult a licensed financial advisor before making any trading decisions. Let's jump right in. Let's start with what happened yesterday. German retail sales were expected to dip 0.4% after a 1.1% rise, a low-impact number that can hint at consumer confidence trends in Europe. In Switzerland, the CPI was forecast to fall 0.1% versus a flat month before, again a modest figure, but one that can influence the CHF's inflation outlook. Meanwhile, manufacturing PMIs in Spain, Switzerland, and Italy all nudged higher than their previous readings, 50.5, 54.5, and 52.5 respectively, suggesting a gentle pickup in activity across the Eurozone and Swiss economy. Even though these releases carry low to medium impact, they help shape the backdrop for today's moves. Moving to today's calendar, the first headline to watch is Australian commodity prices year over year. Commodity movements are a primary driver for the Aussie dollar because a large share of Australia's export revenue comes from metals and energy. A rise in global commodity prices typically supports the AUD, while a pullback can weigh on it. Traders will be looking at the data to gauge whether the commodity cycle is still in a bullish phase, especially after the recent surprise in household spending that we'll discuss in a moment. Next up, France's government budget balance is on the docket. The forecast shows a deficit of 93.3 billion euros, a low-impact figure, but one that feeds in a broader Eurozone fiscal health narratives. A widening deficit can signal increased borrowing needs, which may put slight pressure on the euro if investors start to worry about sovereign debt sustainability. Keep an eye on whether the actual number deviates from the forecast, as any surprise could ripple through the Euro CHF and Euro USD pairs. Spain's unemployment change is another low-impact release. The market expects a reduction of 18,400 jobs compared with a previous decline of 28,700. A slower drop in unemployment could suggest that the labor market is cooling, which may temper Eurozone growth expectations. While the figure won't cause major volatility, it adds another layer to the euro's risk-on versus risk-off narrative, especially when paired with the manufacturing PMI data we saw yesterday. Italian retail sales for the month are slated to rise 0.3%, up from a 0.2% gain in the prior month. Though a low-impact release, retail sales are a direct gauge of consumer spending, a key component of Italy's GDP. A modest uptick could reinforce the view that domestic demand is holding steady, which may lend some support to the euro in the short term. Traders will compare the actual number to the forecast for any deviation that could shift sentiment. Turning north, Canada's trade balance is projected at a surplus of $3.0 billion, down from a $4.2 billion surplus previously. A lower surplus can hint at weaker export demand or stronger imports, both of which can weigh on the Canadian dollar. Even though the impact rating is low, the CAD often reacts to shifts in commodity-linked trade flows, so any surprise in the data could influence the CAD-USD pair, especially in a risk-off environment. Now for a headline that's already making waves. Australian household spending jumped 0.8% in June, far outpacing the 0.2% forecast and even beating the prior 1.3% increase. This 4 times the consensus beat suggests that consumer confidence remains robust despite higher living costs. Such strength can feed into the AUD, reinforcing the narrative that the Australian economy is still resilient, especially as commodity price data arrives later today. Putting yesterday's PMI numbers into a broader context, the Eurozone manufacturing sector is showing incremental improvement across Spain, Switzerland, and Italy. While each individual reading sits in the low-impact zone, the collective upward drift hints at a modest recovery in industrial activity. Analysts often view a series of rising PMIs as a leading indicator for GDP growth, which can subtly buoy the euro if the trend holds steady into the coming weeks. Switching to Switzerland, the CPI forecast of a 0.1% monthly decline points to a potential easing of price pressures. If the actual data confirms a lower inflation rate, it could give the Swiss National Bank more leeway to maintain or even consider easing policy, which would typically support the franc. Conversely, a surprise upward revision could keep the SNB on a tighter stance, putting upward pressure on the CHF. Market participants will be watching this closely for any clues about future monetary policy. Finally, let's connect the dots on risk sentiment. Strong Australian consumer spending and potentially higher commodity prices both feed into a risk-on narrative, which can lift the AUD and other commodity-linked currencies. At the same time, any surprise in the French deficit or Canadian trade balance could shift the tone toward caution, benefiting safe haven assets like the CHF or JPY. Keeping an eye on how these data points interact will help you understand the broader market mood as we move through the day. That wraps up today's market snapshot, looters. To recap, we've covered yesterday's retail and PMI releases, today's key calendar items from Australia to Canada, and the latest Australian spending surprise. Remember, this is educational analysis, not trading advice. If you found this update helpful, hit subscribe and ring the bell so you don't miss tomorrow's Tick to Loot briefing. Stay sharp, stay curious, and I'll see you in the next video.